crypto has entered a phase where I believe it's very macro driven right now. So there are a lot of international policies that are actually affecting the markets in general and how they move and how they range in different areas. I think that also affects how projects and clients are looking for market making support.
This material is for informational purposes only and is not intended to provide accounting, legal, or tax advice, or investment recommendations, or an official statement of Presto or its affiliates.
Hello, everyone, and welcome to the Presto Research Podcast. I'm Min, and I'm here with my boss, Peter.
Hello.
And today we are excited to bring a very special guest here, Glenn. And before we dive into topic, Glenn, why don't you give a quick intro to the viewers?
Yeah, thanks for having me on. So Min and Peter, they are my colleagues from the other team. And I'll just give a quick introduction about myself. I'm Glenn. I'm an investment manager at Presto, and I'm based in Singapore. My main role at Presto is to cover investment opportunities in both the primary and secondary markets. And I also cover liquidity, provisioning, and token market making services for clients. And I also do support our institutional sales teams for any OTC or derivative sales opportunities at Presto itself. Brief background about myself. I got into crypto in 2020 and got into ETH and Bitcoin when it was sub 10K and ETH sub $300, I think. And I decided to pursue crypto full time after finishing my master's program at NUS. And how I started in crypto was I was an investment analyst at Gate.io's venture arm called Gate Ventures. And shortly after, I went on to a family office based in Singapore called Arcane. And now I've landed, I've been at Presto for over a year as well, being an investment manager here.
Wow. So you 10x'd on your investment, on crypto investment.
Yes, I wish I did, because if only I held instead of just traded it around. But yeah.
Okay. You're a trader. Okay.
Yeah, DGen at heart. And I think that's how we all started when we, come into crypto, because it's such an exciting space. And, crypto never sleeps, right? It's 24/7. So yeah.
Mm-hmm. Yep. So I guess for the next half an hour or so, we're going to talk about market making, which is a concept that I still think highly misunderstood even in today's world. So I guess to kick things off, I actually wrote an article about market making. I think that's almost 2 years ago, and I'll quickly go over the basics of what market making is, and from there we'll move on to discuss how the landscape has evolved and what the current state of the market making looks like. So this is just a very high level of what market making is. As you can see, market making isn't a rocket science. It's actually a pretty straightforward concept, and it's been around in TradFi for a long time. And basically, as you can see in this definition, market makers are someone who provide liquidity to the market. And now, why is liquidity important? Well, it allows investors to buy or sell assets quickly, whenever they want and at a fair price. And when you have that kind of environment where trades can happen efficiently, it creates this positive flywheel where more trades lead to more liquidity, and more liquidity attracts even more trading. So I kind of have two examples of why market makers are needed. One, as you can see in the chart, on the right side, it's almost like a shitcoin that's trading almost at a tier 3 exchange. And you can see everyone wants to trade on the exchange that's on the left side, not the right side. And other example is actually this one. So assume that you want to buy a certain token, 40 of A token, right? On the order book A, which has pretty high liquidity, you can buy at $100 right away. But if you look at order book B, which has lower liquidity than the order book A, you can see that if you want to buy 40 tokens, that you have to move the price upwards. And the average price, I think this is going to be $103, whereas on order book A, it's going to be $100. So actually, by having market makers, you can, like I said, the role of market maker, which is trade at a fair price and trade whenever you want. And the last thing that I quickly want to cover, and I think Glenn could expand into more details later, is the structure of the market making deals. And I think this part is where it gets a bit tricky because the structure only exists in the crypto market, not in TradFi. And I guess there is two types of contracts. One's a retainer model, which is pretty straightforward, where projects pay like a monthly fee, 10K, 50K per month, and market maker provides the service. And the other type, which has been more dominant type of the structure, is a call option model where crypto projects loans their token to the market maker, and then also gives market maker a call options where market maker could exercise after 1 or 2 years. So it's going to be like, hey, I will give you like 1% of the total supply for the 2 years. And then I will also give you a call option where, for example, if it's trading at $1, it will be like, hey, you could exercise your option end of 2 year at, I don't know, like $1.5 or so. So I guess these are the two most dominant type that has been out there so far. And I think it's actually a good timing to ask you, Glenn, about, is there any changes happening? Or also, can you actually dive into more details about the structure as well?
I don't know if anyone is watching the podcast, if you haven't read the Presto research report, please go and take a look. I think it's pretty well done. I think it gives a very good overview of how market makers work and how what can one expect from working with a market maker, instead of just looking at this is one extra source of information for people to look at and people to better understand how liquidity provisioning in markets, financial markets work in general. I would say market making space. What's currently happening right now is that we're seeing a lot of crypto has entered a phase where I believe it's very macro driven right now. So there are a lot of sort of international policies that are actually affecting crypto markets in general, and how they move and how they range in different areas. So I think that also affects how projects and clients are looking for market making support with regards to their TG events, and with regards to any liquidity events that they're looking for at this current juncture in time. And I think one area where market makers actually do the primary responsibility in the market, like what Min has mentioned, is actually to enable price discovery for the market participants, like your guys who are interested in the ecosystem, or traders who are like individual traders who are trying to trade the markets and trying to form some thesis on certain tokens and so forth. So market makers, the primary role of a market maker and a liquidity provider in this kind of context, in both the digital asset space and also I'm sure the traditional finance space, is to enable price discovery and enable fair and transparent price discovery for people to trade around the prices without incurring a lot of slippage, without incurring a lot of costs, in the sense whereby they will be able to execute at the prices that they are looking to capture, instead of eating a lot of slippage. And one good example is the order book, the two screenshots of the different order books, where in order to enable price discovery, enable very efficient and fluid trading, and support the flows of the retail, that market makers come in with liquidity at certain bands and at certain basis points in the order book, where to facilitate trades across and crosses across the order book in the buys and sells, in the bids and asks. So that's the primary role of market making, and I think the crypto market makers in the space have all aimed to serve this kind of market requirement, and I think that's very clear right now. However, I think what's unique in crypto is that market makers are currently not regulated, so there may be some ways or other different kinds of services that market makers can provide to clients who have other types of demands, like for example like OTC solutions, treasury management, and also there are some tools and some platforms that have evolved to better facilitate the marrying of both the client and the service provider, which in this case is a market maker, to help with the clients or the project's token generation event plans, which is a huge deal in our industry. We've all heard of platforms like CoinWatch, Glass Markets, and Forged. So those are some of the platforms that actually help to enable, it's like a marketplace where clients can come on and projects can come on to the platform and sign on as a client and conduct RFQ engagements with the platform to search for the next best market maker that they can work with towards their token generation event. So how it works in those platforms is that these clients, they fill up they sign on first as a client on the platform, and market makers who are bidding and then they send out an RFQ. The client send out an RFQ to these platforms where they request for quotes and request for different types of proposals from the market makers and the service providers. And these service providers come onto the platform and they fill up a standardized template or like a Google form consisting of several factors that they have that is required to be evaluated. So very typical things are like the depth of liquidity that they can provide on the exchanges, the spread, uptime, and the loan size required to fulfill this liquidity that they are quoting for across the different venues, across the different books that they have committed for as well. And apart from that, I think what Min also mentioned is compensation, right? So remuneration to your service providers. There's two general ways, like what Min has mentioned, the call option model and also the retainer model. And this is also reflected within the RFQ templates where market makers are submitting to these platforms in order for them to have a holistic evaluation of what the level of service that these service providers are being able to commit for a specific engagement, for a specific project, and how are they going to get rewarded. So what these platforms would do, then they'll collate all these proposals over a period of time from all the service providers, and they'll bring all these proposals back to the client and present to them, the foundation, on a project, and discuss, actively have an active discussion with the foundations and the projects, and provide recommendations on whether some of these proposals do make sense, and whether some of these proposals can be tweaked in a better way in terms of remuneration or in terms of the depth of liquidity that a service provider can commit. Then this is how one sort of evaluation round happens in one of these proposals, and this may go on multiple times as per the client's request, which is in this case the foundation. So that's how most of the platforms work nowadays. Yeah, I do agree. I think it's definitely a more transparent and fair kind of evaluation metrics to put everyone on the same kind of platform. But of course, if you're going through a platform, you are just comparing based on the quantitative factors. So it may also result in a sense of a price war where market makers try to try to showcase or propose as high as possible of an amount of liquidity and depth they can provide for a certain token, and as low as a loan size they can go to provide that amount of liquidity, which will create a price war, which I don't think also reflects the true nature of a working relationship with a market maker. So it's always best to have a mix of both, to evaluate proposals from a quantitative perspective, but also work with your point of contact with the market maker in a more qualitative and communicative, open communication kind of approach.
Yeah, I think this kind of leads good towards our next question, which is, what do projects look for when they choose a market maker, right? You just said when you look at the platforms, it mostly kind of determined by the loan size, call option, whether it has a high strike price or whether you can give up like the lowest loan amount. But there are other factors as well, right? So can you kind of tell us from your experience, like what do projects look for when they choose market makers?
Yeah, sure. I think I've just really covered that a little bit, but the main three evaluation factors I think that's important for a project is, firstly, the depth that a market maker can provide. I think that's very critical and the core of what liquidity provisioning is in our industry. So the depth that can be provided, it can range from a lot of details such as which order book, which venues that a market maker or service provider can cover, and also that venue, the differentiation in venue can also come into effect whereby we have venues that are much bigger than the others. So for example, venues like Binance and Coinbase have a much bigger flow as opposed to small exchanges in maybe specific regions, let's say in Thailand, in Philippines, in Japan, some of these very niche exchanges that are serving a specific local kind of market. And the depths that a market maker can cover in a lot of these international exchanges versus very localized exchanges or venues that are of a smaller scale and smaller flow, that actually should be taken into consideration when a client is actually evaluating a market maker. I think, and that's the most important one. Then the next one would be the coverage, of course. So there may be some market makers that are licensed or have institutional accounts in certain jurisdictions and on certain venues where they can support. So, for example, there are market makers who specifically can support liquidity provisioning on Japanese exchanges or Thai exchanges somewhat. And if a project has identified a target audience that would benefit from high liquidity books in that specific venue, then approaching a market maker who can service that venue is very important because it's more strategic, right? So for example, if I'm a project that has a huge user base in Thailand, and I want my users in Thailand to be able to reflect or have very efficient markets in terms of trading my tokens when it comes out, because my mind share in that specific region is very high, I would want to have engaged one of the service providers to maybe specifically service that particular exchange and venue, or like in holistically look at it from a holistic point of view, service both the international exchanges and also the specific venue. So those are some criteria that projects and teams can look out for when they are choosing their service provider. And the last one, which is of course the most important, and I would say the most vague kind of part of choosing a market maker, is the compensation structure. We've shared about compensation earlier on, call option model, retainers, a hybrid. I think it's always an active conversation to work with the service provider to tweak or come into agreement on, let's say, if it's a call option model, if it's on the overall compensation structure, I would say. So if it's a call option model, clients and service providers typically negotiate on the strike prices and how the strikes are being split into multiple tranches to follow the loan sizes as well. I think one simple example is that, for example, a client can engage a service provider for a year, and this service period of a year you will loan the token to the service provider to perform the market making duties. The total loan amount can be split into 2 tranches. Each tranche can be determined by there's a strike price that determines the call option for each tranche. What I mean by that is that the loan will be split, for example, equally into 50% and 50%. And the first 50% of the loan will have a strike price that's determined in, let's say, TWAP of plus 7 days with a certain X percentage of premium that's attached to that first 50%. And that can be replicated into the second tranche, where a TWAP or average price can be determined after the 6 months of the 1 year service period with a X percentage of premiums. So that can be one of the examples where clients and market makers and their service providers are working on an active discussion to determine the strike prices and the split in the tranches of loans in the sense of compensation structure, I would say.
Yeah, I mean, it sounds like, obviously, we are operating in a very nascent industry. So I think all these working models have to go through some several iterations to kind of perfect the working revenue working model. But have you noticed any changes in the way that the projects demand market making service from after the recent incidents of movement and mantra, where it was very high profile. Everybody talked about these incidents because of its negative impact on the token prices, and maybe there was a wake up call to some projects. So I'm just wondering whether that have impacted the way that the projects kind of demand their market making service?
Yeah, I think the case of in these recent cases that you have highlighted, Peter, what we have seen is I would say it's a work of both the foundation and the project team itself and the service providers that they are engaged with. So like what I mentioned, if there's no demand, there wouldn't be a supply of services. So it was clear that there was a demand of certain alternative services from this kind of service providers, and therefore when there's a demand, there's always someone who's willing to do it at a certain kind of fee, right? And that's what we have seen in some of these cases that are highlighted and has taken the headlines on CT recently in the recent times. There's still always going to be this kind of services that are always going to be required from market makers or what we call market makers in this case in the market. But of course, everyone, even foundations, are a lot more wary about how are they positioning themselves ahead of their own communities. Now that a lot of these things have come to light, right? Because communities now, I mean, crypto is a very sensitive. We are a very sensitive and very close-knit industry. I would say it's still very nascent, like what you've mentioned. So any wrongdoings or any negative sentiment will definitely get extrapolated on CT or any other social platforms. And I think foundations should definitely be more careful approaching some of these conversations that they want to have with market makers to just prevent any thought around like insider exits or that kind of stuff. But I'm sure that conversations like this are still going on with certain projects and stuff. But I think nowadays what I've seen is there's definitely a change of people being more careful with how they managing and handling market maker relationships.
Are you noticing like more projects demanding retained model as opposed to call option model?
Yeah, I think that's interesting. So retainer models have always been in a very traditional finance and it's long stood the test of time, and it's regulated, right? Because you're paying for a service essentially. There's no alignment in terms of like call option upside and the kind of stuff. So I would say that there's still always a mix of both retainer and call option models from projects that are looking for this kind of they are evaluating service providers. One clear distinction from what I've seen with regards to clients who go for retainer models are clients that are well capitalized. Because if you're paying a monthly retainer of X amount of stable coins per month to your service provider, I must be well capitalized enough for my runway to not be impacted by a huge amount when I'm engaging one of the market makers to help with my liquidity on of my token across the venues. So clients who have raised a decent chunk of money, who are profitable in terms of their own businesses, tend to drift towards either a hybrid with a small call option model along with a retainer or a pure retainer basis where we have seen. But then again, there are other structures to a retainer model as well. So in the case of a retainer, clients can also opt to pay in the native tokens rather than paying in stablecoins. So in this case where clients are paying native tokens, then it may be a different case of they do not need to have decent kind of capital that's sitting around that's ready to be paid out on a monthly basis to service providers, but they can also in some occasions say that market makers or service providers can retain an X percentage of the loan that was loaned out to them as a form of remuneration for the services that they've provided over the year. One quick example is a project can loan 1% of the token supply to a service provider for a year, and at the end of a year, the market maker and service provider returns 0.8% or 80 bips off the token loan, keeping 20 bips as a fee to in the form of payment for their services provided. So that can be another structure as well.
Got it.
Yep. I think we kind of, as time passes, I think everyone's getting more clever on the deal structure. And if you actually see the Kaido deal, which is kind of exposed due to the Web3 port and all this incident, is that they actually did the standard stuff, but I think it was for a day or a week. Wintermute and Salini kind of got like certain percentage of token just for the DEX and SEX arbitrage as well. And I think I actually want to hear your thoughts on this as well. And of course, one of the areas how market maker how projects choose market maker is also a quantitative area. Quantitative part as well, but there are other parts like I have seen lots of projects demanding, hey, will you guys have help on like DEXs, or will you guys help on our ecosystem, like through investments or other ways? So are you seeing any of those kind of demand, like projects asking market makers to support, I guess, even DEX trading or maybe TVL boost or whatever it is?
Yeah, I think that's a very good question. I think with regards to TGE events, that token generation events, things have changed, have shaken up quite a bit with Binance Alpha and some of this kind of structures as well. And of course, teams and projects are they have different requirements, and the requirements are always evolving, right? So now with I would say with more of a focus on providing liquidity and on-chain in terms of either AMMs or any DEXs, the demands for liquidity providers and service providers have changed to feed this kind of demands from the exchanges or from all these token generation events as well. So we are also seeing a lot of requests from our clients and potential clients that we speak to, ask if service providers can provide this specific kind of service, whereas they want to achieve a certain amount of liquidity on AMMs in terms of the LP pool size, and also look at just to facilitate the amount of volume that's being seen on this kind of AMMs in order to achieve the next step of listings, which is probably on like platforms like Binance and exchanges like and so forth. So we do see a shift in client demands with the services that service providers are providing, and I think it's still very important to talk to your market makers when you're evaluating them to highlight some of these requirements that you are looking for, so that the market makers can see if they have the capacity, if they have the infrastructure to support this kind of demands. Yeah, and I think it's a good and healthy way for service providers and market makers to continue evolving some of the infrastructure to support, let's say on-chain liquidity provision on venues like AMMs. I think it makes market makers more complex as well in terms of the algorithms that they're building out and the infrastructure that they're building out to service these requests.
So one thing I want to ask is, I think because it's a nascent industry and it's very much not strictly regulated, there are many. It is a fact that I think we have to kind of be honest about it, that the industry has a lot of grifters and bad faith actors, and as a result, we tend to see these funny practices in market making industry. But I think for the long-term growth of the industry, we probably want to bring or encourage, more good faith actor to set a standard. Otherwise, if you don't set the standard, then the regulators will set the standard, and the standard set by the regulators may not necessarily be the best for the industry, right? So I think self-regulation is more kind of a way to go, in my view. What do you think is the best way what are the things that we can do as an industry player, as a good faith actor in the industry, to encourage more good behaviors in the market making business? I mean, if you have any thoughts.
Yeah.
Have you given any thoughts to that?
Yeah, I do. I mean, I do agree with you, Peter. Our industry definitely is part of a sort of way where people just want to do peer-to-peer transfers or without the boundaries of our regulated traditional financial systems, right? And that's how crypto came about. And I think at the end of the day, we can still draw parallels to traditional finance in terms of regulation and good behavior. And of course, traditional finance has centuries of experience and history that has shaped on how it has become today. And I think in TradFi, you still do see blow-ups like, in the '08 crisis and all this kind of stuff where people are pushing boundaries, I would say, with regards to how we do business and how we look at different markets and so forth. And I think this can be the same for crypto. But then again, now that traditional finance has so much precedent that can be used to help our industry or a sub-segment of finance to actually be more regulated and be more fair and transparent and less sort of grifty. We can do a lot. We can take a lot of reference from traditional finance context to actually better uphold some of the core values that we are looking for in crypto. And do crypto projects embrace this kind of sort of self-regulation? I would say, there's always different camps, right? There are camps who come to our industry purely for to extract value and in either a good or bad way, just any way possible. And there are people who are really trying to push boundaries on a new technology, on a new way of finance, on a new way of looking at pushing boundaries of let's say innovation in general. So there are always two different camps, and I can't speak for both of either of them. But I think what we are doing at Presto, of course, you guys are on the team as well, is that we are always upholding what is righteous for us and what is the right thing that we would do in the traditional finance context without doing anything that even us as a firm personally feel that will kind of tarnish our reputation or put us in a more precarious position. When should the regulations come into place? It's just a matter of time when the regulations come into play in our industry. So I think it's always good to position ourselves in as most transparent, as a transparent and more upholding kind of manner as possible. Yeah.
I think 3 years ago when I joined crypto, like market making itself was pretty much joke. Like there weren't any standards. I know one big foundation giving up like 5%, 6%, 7% to the project because they have no idea what market making is. And then there are certain market makers that just set like strike price 10 times what the current market price is. And then, so there were no standards and anything. But as you can see, as the, I guess the landscape kind of get competitive, there are platforms, like you said, those kind of serves as a standard. And then also, I think one big moment and big change that happened was Binance exposing those bad market makers, right? I think by doing that, I think we are going into a right direction, I think. And I think we're very far away from the TradFi standard, but I think we are seeing some changes. And personally, for the past 3 years, I think there has been lots of changes happening.
Yeah, so I definitely agree. We as an industry is making a good progress, despite all the noises and ups and downs. And one good example is the unlock schedule. If you think about it, these days all projects disclose their unlock schedule, right? But if you think about it, maybe 5 years ago, this wasn't the case. Some project did and some project didn't. So even though nobody forced it, I think industry as a whole came to the understanding that the being more like disclosing that type of details is helpful for the industry. So maybe something like that can happen in other elements of the market making. And I think interesting anecdote is what WorldCoin did when they issued a token almost 2 years ago. If you recall, at the time, the WorldCoin disclosed who their market makers are, and then the strike prices, and the token loan amount. But the market reaction was actually very negative, not positive. They were saying, "Oh, this is some sort of a scheme to benefit the insiders, market makers, and they can dump those coins at this price and that price." And instead of taking it as a as a good faith effort by the token project. They somehow used it as something to criticize. And I think ever since that, I think no projects wants to voluntarily disclose terms of the market making. So it's not just the market makers who needs to make efforts, but I think the industry participants as a whole also needs to mature and have a better understanding of what this information actually mean and what the intentions behind disclosing this type of information. So there's a lot of growing up to do, not for everybody, basically. I guess that's my point.
All right. I think that's pretty much it for today. Thanks, Glenn, for your insights. And thank you, Peter, as well. And see you all next week. Bye.
Yep. Yes, thanks for having me.